Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
That is correct. Welcome to the U.S. Markets Wrap. Now, stocks pulled back as a sell-off that has engulfed Wall Street in recent weeks resumed after two straight winning sessions. The Dow Jones Industrial Average lost 0.6%, closing at 41,581. The S&P 500, meanwhile, shed about 1.1%, ending at 5614, thus concluding the day 8.6% off its closing high reached in February, bringing it near correction territory. Meanwhile, the Nasdaq Composite dropped 1.7% to settle at 17,504. For more insights, we're joined by David Dietze, president of the Dietze Wealth Management Group. David, welcome back to the show.
Thank you. It's a pleasure to be with you.
Yeah, pleasure to have you on. Now, based on what you're seeing in the markets, David, how are U.S. investors reacting to all the uncertainty that's going on right now? And what factors, in your opinion, are driving the key movements?
Yeah, absolutely. Well, we are seeing record withdrawals from market, particularly just this past week. I think it was one of the biggest withdrawals from various funds and liquidations by hedge funds that we've seen in a long time. So people are very, very frightened. What are they doing with the money? A lot of it is being rotated right into Europe, where prices have done pretty well. Obviously, we're seeing interest rates continue to drift down. They came down a little bit more today, although we haven't seen the wholesale flow into bonds that suggest that people are absolutely panicked. So, what's causing this is the big U word, uncertainty. People are focused on a possibility of a recession. They're focused on the uncertainty of tariffs. They just don't know. And, of course, with two of the major market entities here having slid into correction, people are moving to the sidelines.
Yeah, despite the uncertainty, though, David, stock valuations remain high. Are we entering a period where investors should expect more bargains, or is the risk of declining profit outlooks a major concern?
Well, people don't know. I mean, you'd like to say buy the dip. The problem is the outlook for profits is starting to weaken here. People don't know what the prices of inputs are going to be given the threat of tariffs. They don't know how strong consumers' demand could be given the weakening we're starting to see in some consumer spending. And so therefore, just because the stocks are down, it may not offer a better value to the extent that the profit outlooks are weaker.
Yeah, so let's look at one of the stocks that's been hardest hit during the market's recent correction. Tesla was down yet again, and it wasn't the only tech name down during the session. Shares of Palantir and Nvidia as well dropped nearly 4% and more than 3% respectively. Do you consider this a tech winter that we're seeing, or perhaps just a passing hail?
Well, you do, I believe, have to look at each of these techs individually. Tesla, I believe, is really the epicenter for a whole host of problems that go way beyond valuation. I think, of course, Elon Musk's involvement in politics and his association with President Trump has queered a lot of consumer demand, both in this country and also over in Europe, for example. We're hearing news that the Chinese EV makers are outperforming. One of them now seems to be able to recharge your car in the time it takes to pump gas for a regular automobile. Tesla's nowhere caught up to that. And there's a lot of question marks as to their outlook for entering the autonomous vehicle market. And of course, in terms of valuations, that's the extreme. Palantir, of course, was the bleeding tip of valuations in terms of the AI stocks, but with some reduction in government spending, particularly in the defense area, the outlook for Palantir isn't so good. And so I think those are two stocks that one needs to be very wary of, while a stock like Alphabet is trading down closer to a market multiple, yet has a much better growth outlook than the market as a whole.
Yeah, David, I want to come back to your point about weak consumer sentiment in the U.S. And with the U.S. pulling back on spending, across the Atlantic, European countries are ramping up defense expenditures. Against that backdrop, how do you see global fiscal and monetary policies diverging? Could this lead to stronger performance in international markets as we're seeing so far this year?
That's a great point. I mean, lost in all the concern about tariffs and so forth and geopolitical instability is the fact that we still have restrictive monetary policy. The Federal Reserve does not believe inflation has been put back into the bottle, and so interest rates remain high. Second, of course, a lot of the tailwinds for the market has been deficit spending, producing record budget deficits here. But, of course, as we all know, with the Doge Commission and so forth, the government is trying to reduce spending, lay off workers, and that's, of course, a negative. On the other side of the pond, a very fiscally prudent Europe is now loosening those constraints as they see the threats to their welfare, with the United States being less willing to back them up militarily, is much higher, and so they're now willing to do deficit spending in order to increase their military readiness, and I think that's helping boost their economies.
That's absolutely right. Let's move away from the military sector to healthcare and REITs and real estate. These are two sectors that you are specifically looking at right now. What is making these sectors stand out, and how should investors position themselves in these spaces?
Yeah, absolutely. I think there's three reasons. One is healthcare and REITs have not performed well. They really missed out on, for example, the tech-led stock run-up over the last 2 or 3 years. Second, of course, particularly healthcare, less economically cyclical. So to the extent that recession or a weaker economy is a risk, people are not going to stop going to the hospital or seeing the doctor when they're sick. And the other thing is, I think that if there is a weaker economy, interest rates are going to stay where they are or more likely start to move down as inflation becomes less of a risk. Certainly, the Federal Reserve is still poised, we'll learn more about this tomorrow, to cut interest rates a couple more times. I think that real estate will do well if interest rates come down. A lot of negativity has been priced in, but I think if anything, people are more likely to go back to work and stop working from home. And I think if interest rates come down, the cap values of real estate will improve, and that could be a safe haven in a very volatile situation.
All right, and David, final question before we wrap up here. Can you share some of your key stock picks for this season?
Yeah, absolutely. So we like energy here. Conoco Phillips is a name we like. It is now at the lowest point since the start of the Ukraine invasion. You've got a very strong dividend, trading about 10 times earnings. And the fact of the matter is, 1.4 billion people on the earth enjoy modern amenities. 8 billion do not. Energy is going to continue to be in demand. We love Archer Daniels Midland. I think in a volatile market, people are going to be looking for dividends. Archer Daniels Midland has paid out dividends for 92 years in a row, more than 25 years in a row. They've increased that. They have a lock on the global trading of commodities. And we also like Supermicro, which, of course, has now started to get its financial books in order. They're a key player in the build-out of the AI data centers, trading at much more reasonable valuations than many of the other AI stocks. So it's a way to play, ultimately, a secular tailwind in AI demand and build-out.
All right, there you go. Conoco Phillips, Archer Daniels Midland, and Supermicro are David's stock picks for the season. David, it's been a pleasure having you on the show. Thank you so much yet again.
Thank you. Take care.
You too. That was David Dietze, president of the Dietze Wealth Management Group. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.